Most people are taught that debt is something to avoid, something that holds you back. But what if I told you that the rich actually use debt to get richer? It sounds crazy, right? Yet, it's one of the most powerful strategies billionaires use to grow their wealth. In fact, 63% of billionaires in the US owe some form of debt, and they don't just borrow, they use it to fuel their financial empires. In this video, we're going to dive deep into how debt can make the rich richer, and how you can use it to unlock wealth, too. From understanding the magic of leverage to creating steady cash flow with borrowed money, we'll uncover the strategies that the ultra-wealthy use to multiply their money. Stick around till the end, because there's one shocking truth about debt that could change the way you think about investing forever. Chapter 1. The Magic of Leverage. Turning debt into wealth. In the world of investing, leverage is a game changer. Simply put, leverage means using borrowed money to increase the potential return on an investment. While it may sound risky, the wealthiest investors know how to turn debt into an asset. They don't shy away from using other people's money to build their fortune. Instead, they use it strategically, amplifying their wealth. The key is in the careful use of leverage. The rich don't borrow for consumption, they borrow for investment. Warren Buffett, one of the richest men in the world, has famously said, "The best investment you can make is in yourself." But the second best might be borrowing money to invest in undervalued assets. Debt isn't always a bad thing when used wisely. For instance, let's consider real estate. When you take out a loan to buy property, you're using leverage. If the property value rises over time, you get to keep the profits, all while only paying back the original loan amount. That's leverage working for you. But here's the secret: debt allows you to control more assets with less money up front. That means you can buy more investments and create more income streams. In 2020, the global real estate market grew by $12 trillion. The wealthiest investors, many of whom use leverage, saw massive returns during this period. If you had used leverage to buy real estate during this boom, your returns could have been exponential. The rich are always thinking ahead, knowing when to borrow and when to stay out of debt. They use debt as a tool to seize opportunities. And they understand that timing is crucial. The wealthy know that when markets dip, it's the perfect time to use debt to buy assets at a discount. Debt also provides flexibility. By borrowing, you don't have to tie up all your capital in a single investment. You can diversify and spread your risk across multiple assets. This ability to use debt to diversify allows for a more secure and expansive investment strategy. To sum it up, leverage isn't about taking on excessive risk. It's about using debt in a controlled, strategic way to multiply your returns. The magic of leverage lies in understanding its potential and using it to your advantage. Chapter 2. Debt as a tool. Investing, not borrowing. While many view debt as something to avoid, the rich see it as an essential tool for growth. Investing isn't just about owning assets, it's about how you manage the money you invest. For the wealthiest individuals, borrowing is a calculated move that drives them toward bigger financial gains. The first step in using debt as an investment tool is understanding the difference between good debt and bad debt. Good debt is money borrowed to purchase assets that generate income or appreciate in value. Bad debt, on the other hand, is money borrowed to fund liabilities, like credit card debt or a new car. Take, for example, the strategy of borrowing to invest in stocks. Investors like Carl Icahn have made billions by borrowing to buy shares in undervalued companies. Icahn's strategy revolves around finding companies that are undervalued, purchasing them using debt, and then pushing for changes that increase the company's value. This is a textbook example of using debt to fuel growth. In fact, studies show that nearly 40% of the total value of public companies in the United States is financed with debt. When debt is used to buy valuable companies or assets, it often leads to impressive returns. Companies that use debt wisely can grow faster, create more jobs, and increase shareholder value. Another smart way the wealthy use debt is through bonds. By borrowing money from bondholders, companies can use those funds to grow their businesses without immediately selling shares or giving up equity. For investors, purchasing these bonds means earning interest on their money while also benefiting from the company's growth. Here's an interesting fact: the richest 1% of Americans control 40% of the country's wealth. How? Many of them use debt strategically to acquire income-generating assets, from real estate to stocks, while the average person tends to avoid debt and miss out on these opportunities. The key to using debt as an investment tool is knowledge. The wealthy don't just borrow, they borrow smart. They understand interest rates, leverage, and how debt works in their favor. The better you understand how to use debt, the more you can make it work for you. Chapter 3. The Rich Get Richer. Why Debt Creates Opportunity. The idea that debt makes the rich richer isn't just a theory, it's a well-documented fact. When markets decline, the wealthy use their access to cheap debt to buy assets at a fraction of their value. It's during these moments that opportunity arises, and the rich know how to seize it. For example, during the 2008 financial crisis, while many people were struggling with debt, billionaires like Warren Buffett were making massive investments. Buffett famously invested $5 billion in Goldman Sachs during the height of the crisis, a move that paid off tremendously when the financial markets recovered. His ability to use debt to buy assets at a discount was a major factor in his continued success. Similarly, private equity firms often use borrowed money to acquire distressed businesses during market downturns. They then turn these businesses around, paying off the debt with profits and leaving behind huge returns for themselves and their investors. This ability to buy low and sell high, thanks to debt, is what allows the rich to keep building their fortunes. In fact, over the last 50 years, the richest Americans have increased their wealth by more than 300%. Much of this wealth has been built by strategically using debt to acquire undervalued assets, whether it's through real estate, stocks, or businesses. A key factor is the tax benefits that come with using debt. In many countries, the interest paid on debt is tax-deductible. This creates a win-win situation for the wealthy, who can reduce their tax burden while using the borrowed money to create even more wealth. The rich also understand the importance of diversification. By borrowing to invest in different sectors or asset classes, they reduce their risk and increase their chances of high returns. This diversification allows them to weather market storms and still come out ahead. Debt, when used correctly, also creates cash flow. By using borrowed money to invest in rental properties or dividend-paying stocks, the rich create a constant stream of income. This income can then be reinvested into more assets, creating a cycle of wealth growth that snowballs over time. The truth is, debt is a tool that can make the rich even richer. It's not about avoiding debt, it's about using it wisely. The wealthiest people in the world aren't afraid of borrowing. They understand that debt, when used strategically, can unlock opportunities that lead to massive wealth. In conclusion, debt isn't the enemy, it's a powerful tool for those who know how to use it. The rich don't just use debt, they master it. By understanding how leverage works, using debt to invest, and taking advantage of opportunities when they arise, they keep getting richer. And with the right knowledge, you can do the same. Don't forget to subscribe for more strategies on how to make money work for you. Chapter 4. Interest Rates and Investment. The Golden Duo. Interest rates are like the wind to a sailboat. They can push you in the right direction or completely derail your investment strategy. The rich understand how to use interest rates to their advantage. When interest rates are low, borrowing becomes cheaper, and this creates a unique opportunity for investors to leverage their money and grow their wealth. Take a look at the U.S. Federal Reserve's interest rate policies over the past decade. In the wake of the 2008 financial crisis, the Fed slashed interest rates to near zero, encouraging borrowing and investment. As a result, stock markets surged, real estate prices soared, and the wealthy were able to borrow at incredibly low rates to acquire high-value assets. According to a report from the Federal Reserve Bank of St. Louis, during this period, the stock market nearly tripled in value, with the richest households seeing the most significant gains. Low interest rates also help in other ways. When you borrow money at a low rate to invest in real estate, for example, you can lock in affordable mortgage payments while benefiting from rising property values. In 2020, the U.S. housing market experienced its most significant annual price increase since 2013, and low interest rates played a key role in driving this surge. Wealthy investors who used low rates to borrow for real estate were able to reap the rewards. The rich also know that interest rates influence the entire economy. For example, when the Fed lowers rates, businesses can borrow more cheaply to expand their operations, often leading to higher stock prices. Billionaire investors like Jeff Bezos and Elon Musk have used low-interest conditions to fuel the growth of their companies, enabling them to dominate industries like e-commerce and space exploration. But interest rates aren't just about borrowing. Savvy investors know that when rates rise, certain sectors, like banks, tend to benefit. Banks earn more money when rates go up because they can charge higher interest on loans. This is why investors keep a close eye on rate changes and adjust their portfolios accordingly. The relationship between interest rates and investments is key to creating wealth. Understanding how to take advantage of low rates while being cautious when they rise can help you stay ahead in the investing game. The rich don't just react to interest rates, they use them strategically to drive growth. Chapter 5. The Debt Secret of Billionaires: Cash Flow over Capital. When most people think about building wealth, they focus on accumulating capital, savings, stocks, bonds, and other assets. But billionaires have a different approach. They prioritize cash flow over capital. Cash flow is the lifeblood of wealth creation, and the rich know how to generate it using debt. The most successful investors, like Ray Dalio, the founder of Bridgewater Associates, know that building long-term wealth is about generating a steady stream of cash flow, not just sitting on large piles of money. For Dalio and many other billionaires, the focus is on creating passive income streams that continue to grow regardless of market conditions. One example of this strategy is real estate investing. The wealthy often use debt to acquire rental properties, which generate monthly cash flow in the form of rent payments. In fact, data from the National Association of Realtors shows that over 90% of real estate investors in the U.S. use financing to purchase their properties. By leveraging debt, they can buy more properties, collect more rent, and grow their cash flow exponentially. Cash flow isn't just about real estate. It can also come from dividend-paying stocks, bonds, and even private equity investments. Billionaires like Warren Buffett have built their fortunes by investing in companies that generate consistent cash flow through dividends. Buffett's favorite investing strategy is buying companies that can generate predictable cash flows year after year, ensuring that his wealth keeps growing, even in economic downturns. What makes cash flow so powerful is that it gives investors the ability to reinvest. For instance, someone who owns several rental properties can take the rental income and use it to purchase additional properties. This snowball effect is the foundation of how the wealthy continue to grow their wealth over time. Another key factor is that cash flow allows billionaires to service their debt without feeling burdened by it. When you're generating consistent cash flow, the monthly payments on your loans become manageable. In fact, one of the biggest risks to debt is the inability to pay it off. By prioritizing cash flow, the wealthy ensure that they can always meet their debt obligations without jeopardizing their investments. In essence, cash flow is the engine that drives long-term wealth. By focusing on investments that generate steady income, the rich don't just rely on appreciation, they build a sustainable path to financial freedom. And using debt to acquire income-generating assets is a key part of this strategy. Chapter 6. Debt as a wealth magnet. How to flip the script. Most people see debt as a burden, a financial weight that they need to escape. But for the wealthy, debt is a magnet for wealth. The secret lies in how they use debt strategically to attract more opportunities and grow their fortune. Take, for example, the concept of debt recycling. This strategy involves taking on debt to purchase an income-generating asset, such as real estate, and then using the income from that asset to pay down the debt. Once the debt is paid down, the investor can borrow again to acquire more assets. Over time, this cycle of borrowing and reinvesting creates exponential wealth. One fascinating case of this in action is the rise of private equity firms. These firms use debt to acquire underperforming businesses, improve their operations, and then sell them at a higher price. A 2019 report from Bain & Company showed that private equity returns have outpaced public market returns by more than 4% annually over the past decade. The key to their success? Debt. The rich also use debt to diversify their portfolios. By borrowing to invest in multiple asset classes, such as real estate, stocks, and businesses, they reduce risk while increasing their exposure to wealth-building opportunities. Diversification, when combined with debt, enables the wealthy to capture gains from various sectors, even if one investment doesn't perform well. But the wealthiest investors don't just use debt for growth, they use it for control. By borrowing money to acquire assets, they maintain full control over their investments while keeping their own capital intact. This gives them the ability to expand rapidly without needing to sell off equity or assets to fund new purchases. The idea is simple. The more assets you can acquire with debt, the more wealth you can generate. The rich don't just focus on paying off debt, they focus on using it to acquire more income-generating assets that can cover the debt and create even more cash flow. So, how can you flip the script and use debt as a wealth magnet? Start by focusing on income-producing investments, such as rental properties or dividend stocks. Then, use debt to acquire these assets, ensuring that the income from them exceeds your debt payments. Over time, you'll find that debt becomes less of a burden and more of a powerful tool for wealth building. In conclusion, debt is not the enemy of the rich, it's their secret weapon. By using debt to acquire assets that generate cash flow, the wealthy create a cycle of reinvestment and wealth generation that compounds over time. Understanding how to use debt as a wealth magnet is a game-changing strategy for anyone looking to grow their financial portfolio. Make sure to subscribe to stay updated with more tips on mastering wealth building strategies.